So good morning, everybody. Welcome to another STC webinar. This one is presented by James Cowper Kreston. Should be a very interesting session. My name is Pim van Baars and I'm CEO for the Silverstone Technology Cluster. So we're a cluster support organization, a not-for-profit organization looking after all the advanced engineering, electronics and software businesses in the wider Silverstone area. This webinar is part of a whole series of webinar that we've done. So if you visit www.silverstonetechnologycluster.com, you can go to our events list and see all our other upcoming events and webinars on various subjects. And do please feel free to join us for those if anything takes your fancy. Please also have a look at our YouTube channel where you can see recordings of our previous events and previous webinars. There's a lot of really useful and valuable stuff in there, so please do have a look at that and obviously pick out the subjects that are most interesting to you. And of course, this session today will be recorded as well and will become part of that. So just in terms of a little bit of housekeeping, I'm about to sort of hand over to Margaret to start the presentation. We will have room for a Q&A answer session at the end of the presentation. So if you do have any questions, then obviously save them up for then. You can either use the chat functionality to post your questions in there, and then I can ask them or refer to you. But by all means, switch on your camera and give us a little wave if you want to ask your question in person or anything like that. So please feel free to do that. So yeah, I think that's about it in terms of housekeeping and things. So I'll hand over to Margaret now, I think.
Thanks very much, Pim. Hello, everyone. My name is Margaret Savory, and I'm a tax partner at James Cowper Kreston. And today with me as well is Michael Atkinson, who's a tax senior manager. So James Cowper Kreston, we're new members of the Silverstone Technology Cluster. We're a full service accountancy firm with about 200 people based in the Thames Valley. So ranging from the Oxford office where I and Michael are based in the north, right down to Southampton. Basically, the A34 and M40 is our corridor. And we specialize in a lot of high-tech startup, spin-out, fast-growing businesses. So really, the Silverstone Tech Cluster is a sweet spot for us, and we're very keen to get to know you better. I've put a profile section at the end of this slide pack, which gives you a little bit of detail about all the things we can do. So do refer to that if you would like to. So we're both tax specialists, and the theme of today is Maximise Your Potential, and we're looking at the tax arena. So we're going to focus on that in terms of both cash benefit and compliance benefits, and Michael will talk to you about that in a moment. So as Pim said, if you've got any questions, please jot them down, save them at the end. We hope to have time at the end. There's quite a bit of content here, so we hope through the recording there will be things, little nuggets and gems of information that you can take back to your business and hopefully will add value to you. So without further ado, I'll hand you over to Michael.
Thanks, Margaret. As Margaret said, I'm a business tax senior manager based in the Oxford office. I work on a range of client tax advisory projects and transactional type engagements here at James Cowper. The aim today is to run through a number of key tax topics at a relatively high level without doing too much of a deep dive into the technical, but bringing awareness for a few key and topical areas. And in doing so, we want to focus on cash maximisation opportunities related to kind of the tax arena, and also throughout identifying areas where there might be compliance pitfalls and helping understand the consequences and how maybe to avoid those pitfalls. So why is this important? Lizzie, if you move on. Yeah, thanks. I mean, we flagged two key reasons here. The first is clearly it's been a very strange last 18 months. Businesses having to adjust and potentially recover if they've been hit hard by COVID and related matters. So there's a real business focus potentially on recovery and also a government focus on helping re-stimulate the economy. So we saw, and we'll touch on the budget in a little more detail very shortly, but we saw a budget back in March, which really was focusing on trying to get businesses and to invest, but also obviously raise cash to pay what is considered to be a high COVID bill, and we saw that with some tax rate rises in that budget. The other key thing and reason we think that a focus on tax at this time is important for businesses is exit and potentially ensuring that the business is ready to exit from a tax perspective. The reason that's important, tax, and personally I do a lot of work in tax due diligence type transactions, and tax is a key area that can both create value through R&D claims, for example, and erode value if things are not quite done correctly, and there could be tax liabilities within the business. So throughout the various topics we're going to introduce, we're going to hopefully be able to give some insight on some of the key areas that we see potentially some of these issues arising, and how you can avoid those. So the first topic we wanted to cover is going back 3 months to the budget, which was in the middle of March. It got quite a lot of publicity at the time, and some of the tax measures were headlines. And we wanted to pick out some of the key ones, by no means exclusively, but the key ones that you see are on the screen. The first being the tax rate increase, which is a massive 6% rise in the corporate tax rate, from 19% to 25%. So what does that mean for businesses? Well, there's potential planning that can be done around that tax rate increase. For example, consideration of bringing forwards income, if possible, to before the 1st of April 2023, when the tax rate increases, or potentially with control over expenditure and moving that back beyond the 1st of April date, so that you get relief at those expenses at the higher 25% tax rate. The second thing we are flagging here is the loss carryback rules and the extension to 3 years. I think many businesses have experienced tax losses over the last 12 months, 18 months, and the government have increased the ability of businesses to carry those losses back to potentially profitable years in the years arising before that. Now, the tax carryback provisions have always been around, and the normal rules allow you to carry back a loss up to 12 months. The rules were extended in the budget to allow businesses to carry losses back up to 3 years. Now, there are some limitations on that. The rules apply for accounting periods ended between 1st of April 2020 and 31st of March 22. And the carryback for the first 12 months is unlimited, as per the existing rules, but beyond that date, for each period in which a loss is carried back, you can't carry back more than 2 million to each of the 12 months beyond the first 12 months per the current rules. So there are some limitations, but there is an opportunity there for profitable businesses who have suffered a loss through COVID to get some immediate tax relief. Now, there is just one thing to consider there. Obviously, there is an advantage in having cash now and making those loss carryback claims, but do consider the 25% tax rate increase. If it's not essential to have make that carryback claim and have the cash, then there is the ability to carry those losses forward and potentially utilise them against income which would otherwise be taxable at a higher rate of tax. The third thing we wanted to cover here is the capital allowances super deduction, which was potentially one of the more headline grabbing introductions in the budget. Lizzie, do you mind moving the slide forward? Thank you. So in summary, the super deduction is a 130% allowance on main pool. That's your kind of your fixtures, your fittings, plant, machinery, commercial vehicles type assets. And there's also an additional slightly reduced relief for what we call integral features. So that's your ventilation, water systems, where you get a 50% first year allowance. So what that means is for your main pool items, for each £100 spent, if you claim the super deduction, you can get a tax deduction for £130. And for special rate expenditure, which gains capital allowances at a slower rate than main pool expenditure, the deduction you're allowed is £50 on for every £100 of spend, and then the remaining amount is depreciated under usual tax capital allowances rules. So it's important to flag this is in addition to existing reliefs, and when I say in addition, I mean that existing reliefs can still be claimed rather than that it's tax. So, for example, the annual investment allowance has been around for a long time and currently is £1 million until the 1st of January 2022, which allows you essentially to take that deduction for the first £1 million of capital expenditure. So a couple of other key things to flag for the super deduction. It only applies where you've acquired assets after 1st of April 2021, which were contracted on or after 3rd of March 2021. And it can only apply to brand new assets. It doesn't apply to second-hand assets acquired by a business. So, I mean, on the face of it, it's a very exciting tax relief. You know, businesses can invest in their fixed assets and gain this quite significant tax deduction up front. A couple of things to flag, though. I mean, essentially what this does is it allows businesses to benefit from the 25% tax rate early. If 130% of the 19% rate is more around about the 25% rate. However, because of the way the rules apply, there are a couple of things to think about in respect to the type of assets that are being acquired, and also the current capital allowances profile of the business. And it might not necessarily be as straightforward as assuming the super deduction is the best route forwards. So, for example, the super deduction assets are not pooled. Now, normal capital allowances assets are put into a pool, which means that when assets are disposed of, the value of the pool is reduced. The super deduction assets, they are treated separately, so that if that asset is disposed of, then there is an immediate balancing charge. You've had the tax allowance for the full value of the asset plus 30%. So when it's disposed of, that's essentially clawed back, and it's clawed back up until 1st of April 2023. It's clawed back with an additional 30%. So, you know, there is definitely consideration around the type of assets that this might be most appropriate for, and the consideration of the best relief to use when making significant investments in fixed assets for your tax purposes. Margaret, I think over to you to cover EIS.
Thank you, Michael. So I'm thinking back to the maximising your cash potential from tax. And so this is about getting cash into your company at the beginning. Most of you have heard of CDEIS and EIS, and this slide is just to remind you of the key points. Nothing really changed in the budget. It is a thing that the HMRC are proud of. Just to give you an indication, the latest statistics for the 2019-2020 year, 4,215 companies raised 1.905 billion under the EIS or CDEIS schemes. So these tax reliefs are about making equity investments into a company more attractive, because your company might be not very known and considered high risk. So it's how to encourage getting the cash in. So this is an incentive to the investors. Who are those investors? Might in the early stages be your family, friends, then going further down the line might be Series A or Series B. So lots of benefits for the individual investor. So this is aimed at individuals, but what you want to make sure is that you are making your company attractive and EIS compliant, so it is attractive. So you get an income tax reduction, very attractive, more with the CDEIS. There is an annual limit for the investor, and I've got them on the slides. And then there is also, it says annual limit, but it is a lifetime limit. in certain circumstances for the company. The great news is, so not only do they benefit from the income tax relief at the point they invest, if they hold those shares for 3 years and you have a unicorn, they are sold capital gains free. And there are some other benefits as well. So that's all the benefits. The thing to watch is there are a lot of pitfalls, and I could spend a whole 3-hour webinar on making sure you avoid the pitfalls. There probably are those. So just the thing to be aware is you need to get specialist advice. Advanced planning is a good thing. And by advanced planning, I mean thinking about your investor profile, thinking about what your trade is, and it's not all trades that can take part. It's typically the trades that don't involve sort of asset rich. So, for example, hotels wouldn't necessarily, or investment properties. And there's a benefit for high-tech industries. So if you're heavily into R&D, which I suspect a lot of you are, the limits are doubled. So there is benefit as well, an incentive to invest in your sort of company. The thing is, you can get what's called advanced assurance from HMRC, and we do recommend that, where you get some certainty that you do satisfy all the qualifying criteria. That's at the point in, so there are lots of pitfalls at the point of entry. You need to make sure you've got sorted, and then you must keep monitoring, because unwittingly you can see companies that don't monitor, and for whatever reason they breach some of the conditions because they knew it was all okay at the beginning, but they forgot to monitor on an ongoing basis. So that's just my reminder about the benefits of EIS, but it isn't a thing to get specialist advice on. And indeed, James Cowper Kreston, we have a specialist team that look at this sort of thing. That's it from me for now on EIS. Over to you, Michael.
Thanks, Margaret. So the next thing I wanted to touch on, and another way to potentially reduce cash spend is potentially perhaps less obvious, but it's to replace expensive cash bonuses with share rewards for key employees. So clearly this can have a number of benefits, both commercially and from a tax perspective, but there are some things to consider. I think the slides have moved on a bit too far, I think. Yeah, that's right. So what are the benefits, potential benefits for looking at potentially incentivizing your employees with shares rather than cash bonuses? And the first is it can help to attract talent. This is not necessarily typically something that larger corporates can offer, certainly not as tax efficiently. It can motivate employees, and importantly, it can align the employees' interest with the shareholders and the directors, which is to obviously increase the share value of the company. It can also encourage retention, because the vesting periods on some of these share options can be a number of years. These options are suitable quite often for growing companies looking at future exit events. And quite often, businesses will qualify for tax approved share schemes. The most well-known one of which is the Enterprise Management Incentive, the EMI scheme, which we'll focus on in the next couple of slides. But there are other schemes as well, such as the company share option plan. We will contrast this slightly. We will contrast this in a bit of detail with unapproved options. Obviously, there is always the option to grant your employees unapproved options, or that is options that don't benefit from particular tax incentives, but they clearly are less tax efficient. So with a focus on EMI moving forward, this slide indicates the benefits to the individual from having an EMI option as opposed to an unapproved option. And details how they work from a tax perspective. So at grant, and the grant is the provision of the option to the employee, in a year naught, essentially, provided that the amount paid, provided the exercise price in the option is equal to the market value at the time of the grant of the option, there shouldn't be any tax consequences for the individual at that point. If you contrast that with an unapproved option, unless the individual pays market value at that point for the market value of the underlying shares for that option, they can get charged a tax on the grant of the option. So there's an initial tax benefit on grant. As you can see in the graph, hopefully the share price increases over time, and eventually there is an event which triggers the exercise of that option, the conversion of that option into shares. And at that point, if the option had been unapproved, there would be an income tax charge on the employee on the difference between the value of the grant and the value of the exercise. However, under the EMI, under an EMI option, there is no income tax charge at that point. Additionally, the company on the exercise of the options gets a corporation tax deduction equal to the difference between the value of exercise and the value of the grant. So clearly the employee is likely then to sell the shares and will get taxed as capital gains on their gain between the exercise price, which is, as we said, the market value of the grant, and the value on the sale. However, if it's an EMI option and they've held it for a sufficiently long time, currently 2 years, they can benefit from what used to be called entrepreneurs relief, now called business asset disposal relief, which allows them to benefit from a 10% tax rate on the capital gain. So, and at that point, the CT deduction under EMI and unapproved is available. So the CT deduction is available for both EMI and unapproved, but on the EMI, you don't get the income tax charge, but essentially for the individuals. So, you know, what are the other factors to consider? Well, you know, it's open to the company to decide which individuals are granted the options. They have discretion as to what the vesting and performance conditions are within those options. There are, as you can imagine, to get within the tax approved scheme, a number of requirements. And this is an area where personally I have seen be problematic several times on due diligence. There are a number of requirements that need to be met and that should be evidenced have been met. And quite often this can be a diligence failing. So the reason that's important is if you imagine a number of EMI options that don't qualify, particularly if it's just due to a clerical error or not having the required documentation on file, then the potential payroll tax liabilities, if there are a number of employees with the options, can lead to quite a big exposure. So it's definitely really important to get this right. The key ones that there's a list there of the criteria, the requirements that are met for that are required to be met for EMI qualification. The key areas that we see being a concern more regularly is around valuation, which care needs to be taken to ensure at the time that valuation is agreed, and it is possible to agree a valuation of an EMI share with HMRC, but HMRC need to be provided with all relevant information, and quite commonly what we see is a separate transaction on or around the date of the EMI grant, which implies a value which is different to the value that's been agreed. So, for example, Margaret mentioned EIS earlier. If there's been an EIS investment at a certain price per share within a certain period of a certain number of months from the EMI grant, you'd expect the valuation on the EMI to be broadly in line with the valuation of the EIS transaction. Maybe with some discounts for minority interest and that kind of thing, but you wouldn't expect a significant difference. Secondly, lapse. It's very important to be aware that the EMI options can be granted for no more than 10 years. So if you have got these options already, or you're considering putting these in place, be aware of the 10-year lapse date, that once those options elapse, they no longer qualify and can't be exercised as EMI options. And I think the final point to take away here is to take care and to retain all documentation. As I say, a due diligence provider is very likely to ask for all of the documentation around EMI, all of the evidence of notification. So it's really important to keep that on file when you have it. I think that's all we wanted to say on that. So Margaret, I think you're going to cover R&D next.
Thanks, Michael. Yes, so a lot has been written about these incentives for innovation, and certainly I spend a lot of time in practice working on R&D tax relief, and I attend the R&D Consultative Committee, which is a 6-monthly meeting with those in the profession dealing with R&D tax relief and HMRC representatives. So I do talk to the policy advisors, and there's a lot going on in the R&D field. Because you're high-tech businesses, I imagine a lot of you are aware of R&D tax relief. So this slide is just to remind you that you have to be a company, you have to have qualifying R&D projects, and there are detailed guidelines as to what constitutes qualifying R&D, and there has to be qualifying expenditure, and there's detailed rules in the legislation about that. 2 schemes operating, the scheme for the SMEs, and then the RDEC, the R&D expenditure credit, for SMEs who get subsidies, and we'll talk about that in a minute, and for large companies. It used to be known as the large company scheme. Next slide, please. So just to remind you of the benefits, on the left-hand side there, we've got the RDEC scheme, which is if you're large and the criteria are more than 500 employees worldwide in a group, or connected. And again, there are detailed EU rules which are still in place at the moment on that. Or if you're a SESAME which receives some funding in any form, so either a grant, could be an Innovate grant, or a subsidy, maybe a customer pays you to do some R&D. Any of those, you're into the RDEC scheme, and basically you get just over 10k of cash back for every 100k of qualifying spend. And then if you're an SME where it's your own internally funded R&D, if you're profitable, you get an enhanced deduction, a bit in the same way, 130% deduction, like the super deduction Michael was referring to, and you basically get just shy of 25k back for every 100k of spend or tax relief. And then if you're loss making, there's an even greater benefit, because you can surrender the extra losses you've generated and your existing losses to get up to 33.5k, or not quite shy of that, for every 100k of spend. And that's of real value to loss-making early startups. They want the cash now. Not quite as good as allowing it to carry forward, especially if you've got the increase in tax rates, but perhaps cash is king, so it's more important now. So that's the framework of the benefits, and nothing's really changed in that over the last few years. However, there has been a lot going on in the last couple of years, and the next slide just focuses on that. So the RDEC, both schemes are seen as sort of flagships to encourage R&D and innovation in this country, and they've just raised the rate of RDEC to 13% gross. The reason why you only get about 10.5k back is because that gross comes in above the line and it is taxable. So the real cash benefit is the net of tax amount. What will happen when they increase the tax rates in a few years? Who knows? Maybe they'll increase the gross rate. Then the bad news is this bit of anti-avoidance legislation. Now, unfortunately, on the one hand, it's been a very good success story, encouraging R&D, or so they think. The other bad news is that it has been targeted by fraudsters, and to the extent that the National Audit Office recently qualified the latest HMRC accounts on for two reasons: the level of benefit fraud and the level of fraud on R&D tax relief. So the spotlight is being shone on the not so good sides of R&D tax relief. And to that extent, HMRC have now got an extra 100 inspectors. So we're expecting to see closer scrutiny of R&D relief claims in the future, because it is part of your self-assessment. So that means it is you retaining the documentation, you self-assess. And they operate, particularly at the moment in COVID times, a pay now, ask questions later. So just because you've got the cash back now doesn't mean they still don't have the rules to look into this in more detail and inquire later. Anyway, as a result of the fraud, the first thing they introduced, and this came in with effect from 1 April 2021, a cap for loss-making SMEs on the amount of cash back you could get. But it's quite generous. It's limited to 3 times your total PAYE and NIC bill. So they're trying to basically say, well, we want to know that you're paying cash into the purse strings in the first place. So it's linked to your total PAYE bill. This also potentially hit a lot of spin outs who perhaps subcontracted out a lot of work to group companies or don't have a very big PAY NIC bill. So as a result of representations from everyone, they have looked at mitigation, and you can be removed from the cap if you satisfy these two hallmarks, which is you demonstrate that you actively manage your IP, and they're artfully vague on that, but it basically is the same as Mike's point before about retaining documentation. So making sure you maintain the documentation for a period that you actively manage, retain IP. And that there is less than 15% of your total R&D costs are subcontracted to a connected party. And connected party, you typically mean fellow group companies. So basically, if you do a lot of IP, you're a standalone company. It doesn't matter if you subcontract to a third party, you will satisfy those mitigations and the cap shouldn't apply. But it is clearly something to be aware of and to check every year, especially if you're loss making and claiming the refund. Then the next thing I've got there is the Haddy case. This is a case that was reported in November 2020, so it is a recent reporting of a case. And there were two key issues. If I deal with the bottom one first, the HMRC basically looked into this engineering company. It wasn't a particularly large claim over a few years, and it's taken several years to get to the courts, but they basically, HMRC challenged to say there wasn't much documentation to prove the R&D that was being conducted. So again, retain documentation, make sure you have it ready, contemporaneous documentation to prove why you are claiming the R&D relief as to the nature of the R&D. And then the other area of focus was that they argued that actually there was little risk. The customers were actually paying for the R&D. And this is back to my previous slide. This was an SME who'd claimed it all under the SME scheme, yet the HMRC successfully argued that some of that the customer money, some of the customer paying for the things was actually subsidizing the R&D, or it was subcontracted to the customer, there was no risk. And so they should have claimed it under the RDEC scheme, the less beneficial RDEC scheme rather than the SME scheme. We believe that HMRC is going to focus a lot on this in the future because they raised it at the recent two RDCC committees. So just be aware, if you think that somehow your customers are paying for your R&D, you need to take a closer look. Couple of ongoing consultations. The rules for R&D were written 20 years ago, so they're a bit not fit for purpose in everyone's views. So they had a consultation in July 2020, which looked at bringing in additional costs because the whole, certainly computing world has changed, but you aren't allowed to claim. The only computing type of thing you can really claim under R&D at the moment is software licenses. So they're looking at a whole load of other costs that tech-intensive businesses use, but currently aren't allowed in the legislation. That was consulted on a year ago, but they've parked the responses because in March 2021, and the consultation has just closed, they basically have thrown the rule bucket in the air and sent out a consultation to look at every aspect of the review of R&D and said basically, is R&D fit for purpose the way we're managing the reliefs? So there were about 20 or 30 questions asking interested stakeholders, basically everybody, what they thought of R&D. Watch this space to hear what the responses are to that. And then finally, just a reminder, in these COVID times, there is the going concern requirement, which basically means that companies have to be going concerns at the time that they put in the R&D claim, which would be referenced to the audit report that the accounts are prepared on a going concern basis, and you're not about to go into liquidation. Just something just to flag up for now. And that is my whistle-stop tour on R&D relief. Hand in hand, or at the other end, is patent box. So no real changes there, but it is going to be more attractive come 2023 when the normal tax rate goes up. So currently, and it's always stayed, there's a 10% tax rate on all your profits derived from exploited patents inventions. So you, as the UK entity, must own either a European or UK patent or an exclusive license to further develop in an R&D sense that patent. There are complex conditions to be satisfied, but once you've got those boxes ticked, the 10% rate is attractive. Interestingly, it can take quite a while to grant a patent. There are mechanisms which you bring in any profits once you've registered for patent box to those patent box profits arising before the patent is actually granted. So there is a mechanism. So if you are applying for patents and you are profitable, key thing is make sure you're profitable, maybe there's scope to elect into the patent box. Just to be aware, this is the key thing that in fact started today. It's bye-bye the old rules. 5 years ago, they had some transition rules come in, which were to expire on the 1st of July 2021. Those is today, so very timely. So everyone must follow the new rules. And the new rules basically require you to track and trace your R&D spend to the patent box. There has to be some mapping and quantification of that in the form of what is known the R&D fraction. And you should have been gathering that data for a few years. So it is one to watch that the R&D fraction, which can affect how much patent box benefit you get, is now mandatory. And you have to also look at things on a much more granular basis. There are some rules where you can be exempt if you're very small, but it is something to be aware of. Today's the day, it's only new rules apply. And that's all I have to say on patent box. Thank you. Over to you, Mike.
Great, thanks, Margaret. So the next topic we wanted to cover off is the changes in rules to off-payroll working, particularly where workers are engaged via personal service companies. It's not to say that it isn't important to focus on all off-payroll workers. I mean, obviously a number of businesses engage independent contractors as individuals rather than through companies, and that has its own risks, which are indeterminate employment status, which are quite similar to the rules we'll talk about later in respect to personal service companies. But the reason we're focused on personal service companies today is because the rules changed on the 1st of April 2021, and that change of treatment from on the 1st of April was to bring these types of arrangements in the private sector into line with the public sector treatment. Now, this is quite commonly referred to as IR35. You may have heard IR35 in the private sector as a bit of a buzzword in tax up to and beyond the 1st of April. Essentially, the IR35 rules in the public sector were introduced a few years ago following what were deemed to be a kind of abusive arrangements in particularly in the IT and journalism industries, where individuals were being paid into their companies and the tax authorities were missing out on tax, despite the fact that the relationships looked like an employment relationship in fact. So what these rules essentially do is they move the determination of whether an individual is an employee or truly an independent contractor from the personal service company, where it sat up to the 1st of April, onto the end user, onto the client, which maybe your business is, where you're engaging individuals through these companies. Now, what the key point to note here is that this is only going to be an issue if the underlying worker is in fact an individual who should be treated as an employee. So that there are a number of considerations to make in respect of each of those individuals. This, I'd say, is probably, certainly in my experience, one of the most common due diligence findings. Companies do engage, quite often companies engage, particularly in the IT industries, do engage individuals through these personal service companies. And where those relationships in fact look like one of employment, so for example, where they've been engaged for a long time, when they're paid an amount commensurate to a full-time salary, for example, if that hasn't been treated as an employment relationship for tax purposes, i.e. PAYE and national insurance hasn't been paid, exercised, it can quite quickly rack up to a significant liability. So take, for example, 5 contractors paid £50,000 over 3 years. In default of the, if they should have been treated as employees by the company, you can quite you're looking at around about 200,000 of unpaid PAYE, which is an obligation of the business. So this is an important area to get right. So this particular slide summarises the the arrangements we're talking about here. So you have the worker on the right hand side. That worker is an employee of his personal service company. That personal service company does something for the fee payer, the client, potentially your business on the left hand side. And in respect of what he does, he gets paid an amount under a contract with the company, or the company gets paid an amount under a contract with the company. What needs to be looked at is if it were not for the personal service company, would the relationship be that of an employee or subcontractor between the worker and the fee payer client? If the answer to that is on the facts it's an employment relationship, then there is a deemed employment payment under the rules between the fee payer client and the personal service company, and income tax and national insurance should be withheld through payroll on that deemed payment. So just to flag, these rules do only apply to medium and large companies. So moving to the next slide, you can see the criteria for what medium and large, what constitutes a medium and large company for these purposes. So turnover 10.2 million, assets, and that's total assets, not net assets, of over 5.1 million, and employees of over 50, employees of over 50 for the company. So not all companies will necessarily fall into these rules, but they're not significant thresholds, unlike sort of SME and EMI, which are set higher than this. So it's definitely one to monitor. So the key takeaway here is if businesses do engage contractors through these companies, is to do an exercise to assess whether or not those individuals those engagements should be treated as one of employment and subject to these off-payroll working rules. And moving to the next slide, we're not going to spend ages on this. These are some of the key things to consider when determining whether a worker is an employee or a contractor. So there is a number of case law sitting, and a large amount of case law sitting behind this determination, but some of the key ones are, can the individual send a substitute to do their work, or does it have to be that individual? If it has to be that individual, it points towards a personal service, which is more likely to be an employment type relationship. Does the business have control over that individual, that worker, to determine where he or she works, what he or she works, and what they do, for example. Financial risk is an important one as well. If, for example, the arrangement is a fixed fee and the individual has to do whatever work is involved for that fixed fee, they are bearing the financial risk, and that might point more towards an independent relationship than an employment relationship. A day rate, for example, might point more towards an employment type relationship. So it's a complex area. Fortunately, HMRC do produce a useful checker tool, which businesses can use to enter the fact pattern of their individual contractors with personal service companies, and indeed, actually, the tool can be used for directly engaged independent contractors as well. Put in the facts into the tool, and then the tool will give a determination of whether HMRC considers that individual to be an employee or a genuine independent contractor. And HMRC have said, provided that the information input is correct, they will stand by the result of that tool. So it's definitely a useful item to have. And if this is something that you think needs to be looked at, I would recommend usage of the tool. So the tool can be found with the links contained in the slide pack, and if this is something to look at, I would recommend looking that up. So that's a very quick summary of awareness of those rules. As I say, it is something we do recommend is got right, and something that quite often does come up as an issue on diligence. So yeah, we recommend looking into that if it might apply to businesses. The next thing we wanted to cover very quickly is another area. Again, we've put this in because it's an area that can result in tax liabilities across not just in the UK, but across multiple jurisdictions if it's not done correctly. Is just expansion overseas, and broadly we categorize this into three three different events, if you like. So the first being the first non-UK customer of a business, and at that point you're considering generally things like indirect taxes, so VAT obligations, because you have a customer overseas. You may be generating VAT obligations overseas, customs and import type duties to consider at that point. The second point is around employment and potentially engaging an employee for the first time overseas. At that point, there's payroll tax considerations where they should be paid, whether the what payrolls need to be set up, whether there are different employment law type requirements, what the salary should be, how that should be benchmarked, but also whether that individual is doing something that might create a permanent establishment or branch of the business in that jurisdiction. And quite often, if the answer to that question is around permanent establishment is yes, a business might consider establishing a non-UK entity. Now that might be a branch, it might be a subsidiary, and whether it's one or the other will largely depend on legal and tax and commercial analyses. But at that point, there's going to be a requirement to consider things like transfer pricing. Is the right amount of profit being recognised in both jurisdictions to make sure the right amount of tax is being paid in each? Are there any kind of tax implications of repatriating profits and back to the home jurisdiction? So this slide really is just a flag. If your business is going to experience an expansion event overseas, be it a customer, employee, or potentially looking at establishing an entity, we do recommend it's something that you look at in detail, because there can be potential implications in multiple jurisdictions. And I think that takes us to the end of the things we wanted to raise as part of this webinar. Margaret, did you want to?
Thank you. And Lizzie's just put up our profile. So just to give for your reference a bit more about us, the Kreston part of the name, which feeds in nicely to what Michael's just been talking about, is we're under the Kreston group or firm of accountants, which is an international network of accountants. So often we are in contact if people go overseas, a client and says, do you know about Hungarian tax? We can pick up the phone and link them in with a colleague in a Kreston firm in Hungary, say, for example. So a little bit about us. We've got about 40 tax specialists across all the specialisms, including VAT and customs and excise, which they're very busy, not surprisingly, at the moment in this post-Brexit world. So just over to the last slide. I'm Margaret Savory, and there's Michael's details. Please email if you've got any detailed queries. But is there time, I think, Pim, for some questions now, if any questions have come in?
Yeah, absolutely. So if anybody does have any questions, then please use the chat functionality to put them in, or indeed switch on your camera and give us a little wave, and we can refer to you. But thank you, Margaret and Michael. Very, very thorough, very comprehensive presentation. Very, very interesting. One question I would like to kick off with, if that's okay, is sure. We're hearing a lot in the news on the furlough scheme coming to an end and COVID relief measures and people returning back to work and all that sort of stuff. Are there any implications around that, the whole returning to work after COVID and the change of the relief measures and all that sort of stuff that impacts on any of the issues that you face?
I think businesses will be starting to factor it in. The prime one is cash flow. So of course now you need to have the cash flow, and you might sort of get doubling where you've got the deferred payments coming through if you've deferred payments as well as the actual real payments. I think the key thing is always to correspond and communicate with HMRC. So they are what HMRC hate the most is it's like all situations of debt, being an ostrich and not telling anyone. So the first thing is always to talk to HMRC, because there are various formal mechanisms if you think there's being a struggle. One of the things I just want to, it's topical because of course today a bit of the furlough ends, in terms of one thing to remember, and I see this at the moment from doing R&D tax relief claims, just remember if you have put staff on furlough, you can't be claiming R&D tax relief for the time they're on furlough, because by definition if they're on furlough they might be being paid, but they are not to be on furlough, you're not doing any of your doing, i.e. they are not doing any R&D work at that point. So it's just to monitor your R&D claims over the period. And HMRC have confirmed that this is the case, that you won't get R&D tax relief for if your R&D staff members are on furlough over the time. And just think about what, it's a review as well, because what's happened to your share valuations and things like that. Will suddenly all your options become severely underwater? All those things that you're using to motivate your employees, are they not really motivational at the moment because they're so far underwater that they will never recover? But that's a sort of valuation issue. That's just a few thoughts.
Excellent. So you've obviously talked about sort of the tax rise, but do you think there's more to come there, or more other significant changes that will happen in the new budget? Do you expect to see anything else coming up there, or is it just a general hike and that's it?
Michael, do you want to answer that one?
Yeah, absolutely. So it's difficult to say at this stage. There were a number of consultations announced in March. There was a separate tax day to the budget. They of course may result in some changes going forwards. Whether or not that's in this year's budget, next year's budget, or the year after, remains to be seen. The R&D consultation Margaret touched on, I think, given the pressures that the government and HMRC are facing at the moment, we're probably expecting that, I think fair to say, Margaret, 2023 is the earliest we'd expect any changes there.
But don't hold us to that prediction.
Yeah, yeah, of course. And the other thing I think is is in the news more often than not around tax and budget is changes to capital gains tax, possibly including an increase in the rate there. There's been the Office of Tax Simplification has been looking into capital gains in quite some detail. So we'd be surprised if there wasn't some changes within the next budget or two to capital gains tax, or potentially capital gains tax rate.
Right. So certainly keep your eyes out on what might be happening for you in the future, type thing. When you mentioned that it jumps up to 25%, is that just across the board, all companies are paying 25%, or are there other exemptions or different variants?
Yeah.
In there?
No, that's a completely fair point. I think the 25% rate will apply to companies with profits over 250,000 or more, taxable profits at that level or more. There will be complicated calculations to work out whether or not a company meets that threshold. Generally, what we'd expect is for the profit to be divided by the number of companies in a group, so that a large company group doesn't have multiple 250,000 thresholds. For companies that are small, there is the rate remains at 19% as it is currently, and that's I think that's £50,000 up to profits of £50,000, that threshold, and then between the £50,000 and the £250,000, we return to what we call marginal relief calculations, which calculate where what rate should apply between those thresholds, and essentially that will be designed so it's a sliding scale. So between 50,000 and 250,000, that the rate will gradually increase up to the 25% rate.
Excellent. So in principle, good news, but obviously it's not as straightforward as originally led to believe. How surprising, I suppose.
As with all things tax, yes.
Yeah, exactly. I kind of had a question on the super deduction thing as well. So that's does that also apply to sort of capital outlays in terms of if you're moving business premises or upgrading your business premises or anything along those lines, or is it not used for that? Because I'm aware that a number of our members are into that sort of sphere, or definitely sort of doing it this year and things. Does that apply as well, or is it much more focused around like buying new machinery and things like that?
Yeah, it follows the capital allowances treatment. So where a business invests money in new premises, there's going to be a certain amount of that that's not going to be eligible for capital allowances. There might be particularly if it's a new building, you might be able to claim structural building allowances on it. Those allowances don't benefit from the super deduction. Where you have assets that would qualify otherwise than for capital allowances, the super deduction can be claimed in that case. So in terms of the assets, it's very much in line with the previous rules for qualifying for capital allowances. The treatment that the super deduction generates will depend on whether that's a main rate asset, and I think that's generally your plant and machinery, commercial vehicles, that kind of thing, or special rate, which is the reduced 50% upfront deduction, which is things like heating system, water systems, air conditioning systems. So there will be differential treatment, and the availability of the super deduction may not be available for all of our element spend, but it's definitely worth having an exercise carried out in terms of how that spend can be categorized between the different qualification levels.
Yeah, excellent. So it's definitely worth checking out what the possibilities might be, and either get in touch with yourselves or your current accountants on what the situation is there, I suppose. Excellent, really good. I'm conscious of time, so and I don't think we've had any other questions in, so presumably people want to follow up with you sort of more personally afterwards, which is perfectly possible. So as per usual, what we'll do is we'll send a recording of this webinar to everybody, and everybody that's registered will receive an email with Margaret's and Michael's contact details as well, copy of the presentation, obviously recording of the video as well. So there's plenty of opportunities for people to follow up afterwards, if they want to do that. More than free to do that. Of course, we as the SEC, I mean, we exist to help companies as well. So by all means, get in touch with any of the team to see what we can do to help. You know, any questions that you might have or anything like that, you know, please get in touch and let's see what we can do. And with that, I'd really just like to thank Margaret and Michael again. I thought it was very really good. Really enjoyed it. So thank you very much. Obviously, thank you for joining today. Now, as per usual, what I would like to do is run a little poll, a little feedback poll for everybody here. It will only take about a minute or so to complete, but if you wouldn't mind, you know, sort of answering the questions and ticking the boxes on what you thought of the webinar, but also most importantly, let us know what you would like us to cover with these sort of webinars in the future, so we can make sure that we put on relevant content, of course. So yeah, please do tell us what you want to hear about. So while everybody's doing that, I just want to thank everybody watching on YouTube for watching. Hope you enjoyed it. Check out all the other videos for more useful and valuable topics. And on this video, apparently, if you could like, share, and subscribe, something to do with algos, rhythms, apparently it's really good. So if you could please do that, that'll be great. So thank you very much for watching, and we'll hope to see you again in the future. Thank you.
Thank you.
Thank you.